Hello guys, good evening. Welcome to Trading Gym and आप सभी का स्वागत है आज के मेरे लाइव सेशन में and today we are with the new purpose. We are with the new purpose like we are just here to learn something new and the topic here is the fixed income securities, right? So आज हम सीखेंगे fixed income के बारे में. So we are definitely going to learn something new. So yes, these are my notes and I'm going to explain these all the things in very easy way. So आज का अपना सेशन होगा इस पे और मैं आपको समझाऊंगा व्हाट इज बेसिकली स्ट्रक्चर्ड फाइनेंस एंड सिक्योरिटाइजेशन प्रोसेस एंड एंड वेरियस थिंग्स रिलेटेड टू इट. सो यस, सो ये बहुत ही एक्साइटिंग सेशन होगा, एंड तक देखिएगा आप लोग and I'll explain it to you very easily and very much easy manner. Okay, so yes, let's get started with the analysis part. तो देखिए एनालिसिस कैसा होगा आज हमारा कि जस्ट अ मिनट, लेट मी कनेक्ट दिस. व्हाई इट इज नॉट गेटिंग कनेक्टेड यार. ओके, सो जस्ट अ मिनट गाइस.
Collateralized
Let's get started with this.
mortgage.
Okay, yeah. Okay, so आज हम बात करेंगे सिक्योरिटाइजेशन के बारे में. So before that, we will talk about what is basically the structured finance, ST, structured finance. Okay, so structured finance is basically okay. Let me remove this thing. Okay, arrow. यार ये कैसे बात करता है? Okay, no problem. Okay, so we will talk about structured finance here only. So actually, I'm new to this, so no problem. Okay, so structured finance is basically the structured finance uh, is an innovative product. Structured finance basically is the financial product which is built up in a very innovative way. So it helps the investors to raise their money. So here we can take the reference of it. So structured finance is basically a customized way. Okay. So structured finance is basically a customized way of arranging the financial product, and it is makes the financial product easier also. Okay. So structured finance is basically a customized way of arranging funding and managing risks for bigger companies and financial institutions. So instead of arranging the simple loans, what bank does is that it tries to arrange the loan in such a way that it is easier for the borrower to raise money. So we can say that structured finance is an innovative way uh, to create loans, which is especially easier for the borrowers to raise money. And with the help of that, they can definitely easily spread their risks and easily able to manage their risks by spreading the risk in various types of assets. So recently, if I talk about the news, which was of alpha alternatives, ALPERVES. Okay. So alpha alternatives recently on 25th February were managed to raise 5,500 of raise 5,500 through the structured credit fund to invest in the equity investments, debt restructuring, and also in the what's say uh, special situations. In special situations.
So it was only possible for it because it raised through its structured credit fund and not through the traditional way. I think this has attracted the investors. Uh, so this has attracted the investors, and definitely this was some of the recent news about structured finance. So structured finance includes basically various products such as mortgage-backed securities, asset-backed securities, commercial mortgage-backed securities. So yes, so then I will be talking about the okay. So we are done with the structured finance products. So now we will be talking about the uh oh shit, what happened with this? Okay, so now we will be talking about the uh, securitization process. Okay, CC, beyond. What is basically a securitization? So securitization is basically okay. So so let me first begin with the definition. So securitization is a process in which the financial instruments which have the capability to generate the future cash flows, such as mortgage-backed securities, such as loans, loans, receivables, credit card loans, etc., uh, are pooled together, are packaged together in form of assets. And here, package of pool of assets is known as collateral. And then this package is sold to the SPVs. So, and then, so this package is sold to the SPVs, and through SPVs it is sold to the investors. So here there are many complex terms. So I will try to make it easy for you. So let's say these are the retail players, and this is the bank. This is the bank. Okay. So and this is the bank. This is the HDFC Bank. HDFC. HDFC. Let me make it better for you all. So this is an HDFC Bank, HDFC. So this retail investor, not retail investor. I think I would say HDFC is borrowing the money from the retail guys, customers like us. We are depositing the money in the bank for let's say 5%. On this amount, we are keeping there. We are investing there, not investing, just keeping with the bank. Uh, we would get 5% return on it. So HDFC, what HDFC will get the 100 rupees, right? So now what HDFC does is that HDFC will try to lend this 100 rupees to on the higher interest rate. That is, let's say 10%. So HDFC will lend 100 rupees for the purpose of, let's say, loans. So loans के लिए इसने 100 rupees lend किए, right? So now, uh, so now such loans are given to multiple people, multiple hundreds of borrowers, thousands of borrowers. Okay, so these loans are given to hundreds of people. So now HDFC Bank, this is a traditional type of transaction which HDFC does. But what exactly the securitization is, but when so its need arise when there is a shortfall of liquidity. When 100, it takes 100 rupees and gives 100 rupees. It lends 100 rupees. So, what if the customer comes and tell HDFC Bank that I want my 100 rupees back? It has no 100 rupees. And if let's assume that these loans are of 30 years because these are home loans. So its tenure is very much high. So bank won't be able to pay 100 rupees. Okay. So there is a liquidity issue, liquidity constraint for the bank. So, uh, so just to resolve this, what HDFC does is make a use of the structured finance, which is in that it uses the securitization process. So what does it do? That it creates its subsidiary. Okay, so it creates its subsidiary. So it is basically HDFC subsidiary, but it is a separate legal entity. So that separate legal entity is known as SPV. That is separate special purpose vehicle. Okay, special purpose vehicle or special purpose entity. So the assets, the it has the assets, right? So it has the in the balance sheet. it's in the balance sheet of HDFC, the assets of loans, like loans, okay? So it has various loans in this. So these loans are transferred to the SPVs. So now these loans are of SPVs, right? So there are multiple loans over here, like many loans. So what SPV will do is that it will try to bundle these loans in one file and try to make a portfolio of it. Portfolio, portfolio. Okay, it will make a portfolio of it, and and SPV will try to sell this portfolio to the another set of investors. So here there are some investors. Okay, A, B, and C. A, B, and C. So these invest investors are basically mutual funds, big mutual funds, or pension funds, or LIC like investors. These are not retail investors. So yes, definitely they will be purchasing the asset. So now here the investors will pay the upfront money to the SPVs by buying this portfolio, and this SPV will transfer this to the HDFC Bank. So it will get the 100 rupees here, like 100 rupees it will get upfront. So what in this whole structure, what HDFC Bank did is that it created the mortgage-backed securities, like it created a mortgage of securities, right? So instead of waiting for 30 years to collect the 100 rupees, it transferred its assets, its files of loans to the by making the other company, that is SPV, and SPV tried to sell those loans to the other another set of investors. So what was the whole benefit and whole purpose of this is that the HDFC got the liquidity. So the liquidity problem was solved. So here the liquidity problem of the HDFC was solved. There are also other reasons for securitization, which HDFC does, is that the uh, funding cost. It reduces the funding cost, right? Funding cost. So let me write it for you. Funding costs. Funding cost gets reduced. Okay. So let's say this is not a HDFC bank. It is DHFL. Okay. So DHFL had a bad reputation recently, I mean, when it lastly existed. So DHFL was the company which was not reputedly known in the market. So if DHFL try to raise the money, investors won't invest in it. So what DHFL does is that it created an SPV, and through SPV, and as soon as it created the SPV, there was no connection in between SPV and DHFL. So here DHFL created a separate legal entity. So that this is the reason why SPV is also known as separate legal entity and bankruptcy remote entity, especially. So there was bankruptcy remote because when if the even if the DHFL gets bankrupt, then it won't affect the investors of the SPV, right? So SPV is bankruptcy remote. Okay, so I will write it here in the recent font. And it is a bankruptcy remote. Bankruptcy remote NTP. NTP is the bankruptcy remote entity. Okay, so that means bankruptcy remote entity. Okay, so so yes, so we were talking about reducing the funding cost. So as soon as it created the SPV, transferred the assets to SPV, then SPV will try to raise the money on the basis of these loans. So as now there is no connection between DHFL and SPV, other investors would definitely like to invest in this SPV because it has no connection with DHFL. So if earlier the investors were not willing to invest less than 11%, it can definitely raise loan at 8%. So so here we had the benefit of 3%, and therefore our funding cost was reduced because of SPV. So this was the second reason which securitization process is done. And the third reason is also for the bank's asset liability management. It manages its asset and liabilities very well. If it's borrowing the money for 1 year and if it's lending the money for 30 years, then there is an asset liability mismatch. So through SPV, we can get the upfront money and a liquidity position. Liquidity, as just like a liquidity constraint is resolved, the bank is able to manage its asset liability very well. Then also we can say that asset liability mismanagement. Okay, so for now we will consider these three things, and this whole thing is about securitization. Okay, so yes, so if I want to add over here something, so yes, okay. Active layer. Oh, yeah. What happened to this one? Move down. What is this? Nothing. Okay. Okay. So this whole process was as uh, let me write securitization. You can't save this to PC. Please choose the other location. Okay. We'll save it in download, right? Okay. So okay, यहाँ पर हम सेव करेंगे इसको. And so this is all about the SPV and image properties. How to take a new page? I'm not getting it. How can I create a new page? I'm trying to create a new page, but okay, no problem. We will get a new one. Okay, new sheet. Okay, okay, no problem. So we can definitely get it from. Ah, so that the thing which I was explaining to you was about securitization, was about yes securitization, and we can take here securitization image. Patient and started with currently updating. Okay. So yes, तो तभी हमने बात किया हाँ सिक्योरिटाइजेशन प्रोसेस के बारे में. So here we had the many parties involved in it. So the party was bank. So here bank was a party. Then there was something called SPV. Then there were investors in it. Then the last thing which we will discuss is the trustee. SPE. Okay. So bank. So if I talk about the bank is the one who is originating the loan, who is having the original assets with him, such as loans, receivables, uh, all the assets. So it is the bank who is originating this process of selling the assets to SPV and transferring the assets to SPV for reduction of funding cost or get the better liquidity, anything. So here bank is known as originator. Yes. So originator is the one who creates the loan. I mean, not creates the loan, who is the owner of the original assets and the one who starts this process by selling the assets to the SPV. So SPV here is issuer, I would say, because it issues the loan by buying the assets from the bank, and now it's a separate legal entity. So SPV is now a separate legal entity because takes it takes a great measure that it doesn't affect the bank's financial health. I think that's why SPV is also known as bankruptcy remote entity, as we discussed earlier. So this is the role of SPV, and then here only we will talk about the trustee. That SPV creates the trustee. SPV appoints the trustee. SPV appoints the trustee. Okay, and the trustee is the independent third party, which is neutral in this transaction. Neutral third party. third party. Okay, it is a neutral third party which oversees this transaction and see and takes the measure that your investors are not getting disadvantage of this transaction. Okay, so to safeguard the interest of the investor, the trustee is appointed by SPV so that there is a fair transaction in the whole structure of securitization and there is no injustice. So, uh, in short, it looks out for the legal matters and the rights obligations of the investors. So this is the main role of trustee, which is created by SPV. And lastly, if I talk about investors, so investors here are mutual funds, pension funds, and LIC who invests in the company, I mean SPV, and take the advantage of it. So here, why investors would invest in the SPV? Because SPV tries to give them the loan, give them the interest of higher rate. So, for example, if I as I said in that just a minute. Okay. So as there I said, this was the bank, and the this one was investing it for five rate, right? 5%, and it was giving it for 10%, lending for 10%, right? So if SPV will sell this to the investors for let's say uh, 8%. Okay, so 8 or 7%. We will assume it as 7%. So because investors, it will say to investors that normally in the market the rate is going to at 5%, right? But we will give you 7%. But in return, what they will ask why you are giving us for 2% extra. So SPV can say that these 2% extra are for two reasons. One is the credit risk. We are transferring the credit risk to you, credit risk. Okay. And the second thing is the withdrawal right. That you can't withdraw the money. Withdrawal right. You can't withdraw the money, right? Because so how will you get this money back? So as these are my borrowers. These borrowers will repay me. Just a minute, guys. ये थांब रे, विनय थांब. विनय. So it will transfer the two things to it. That is withdrawal right. So SP will say to these investors that you won't be having the withdrawal right because so you won't be having a withdrawal right because as soon as these borrowers will repay the money, bank it will transfer to SPVs and SPV borrowers will transfer to SPV. SPV will give to these investors. But if any of the borrower defaults, right, then you will have to bear the credit risk. So if there are three investors, they will have to bear the loss in the tranches. So that we will discuss in the recently. हम discuss करेंगे हम लोग. Yes. So here the net interest margin of the bank is reduced to 3%. But what is the benefit of the bank? That it transferred the credit risk to the what I will say, it transfers the it transferred the transfer oh sorry, my bad for this language. It transferred transferred the credit risk to the credit risk. Uh, it transferred the I would say that transferred the credit risk and withdrawal right, and the bank is now free from all the risk, from not all but mostly free from the risks, and it has reduced its margin, but it has made it safe. Okay. So yes, this is the benefit of securitization, and this is the whole purpose of securitization. This is the whole purpose of securitization. So yes. So now we will be, as we spoke about the parties of the securitization, the how the investors get their money, and how the bank transfers it risk to the investors. So in the next slide, we will be talking about uh, section two. Okay. So in the next slide, we will be talking about how the investors, uh, the money is transferred to the investors, and how the time tranching and the credit tranching is done. So we will be talking about the structures of securitization. Okay. So let's create some new file. Okay. So yeah, we are now here, and here we will be talking about the structures of securitization. Okay. So we will be talking here about structures of securitization. Okay. So as we spoke that investors will get money through SPVs, right? So investors has the advantage that they have the direct claim over the assets on the of the SPV. They won't be get disadvantaged if the they are bankrupts. So okay. So now the reason the question is that how investors will get the money. So there is a credit tranching. So there is something known as credit tranching. There is something called. Just a minute, mom. Credit tranching. Credit tranching. The second is time tranching. Okay, so in credit tranching, if I say that SPV, if I say that SPV is going to transfer the money, and if SPV and okay, so investors, if I talk about the investors first, there are three investors here, A, B, and C. Okay, so A, B, and C. So uh, if SPV is paying the investors their money back, okay, so it will pay. Okay, okay, just a minute. So it will pay the money equally to all these assets, but just there will be a difference in returns of interest. Uh, three of them will definitely get the interest, but the interest rate, but let's say that A investor is is a very conservative type of investor, and he wants safety. Okay, so as he wants safety, we can say that he is demanding less return. He's okay with the less